Hi, I'm Greg Welborn with First Financial Consulting in Pasadena, California. You know, we've done a couple of videos on stocks and why you ought to own them, and bonds and why you ought to own them, and in both of them I kind of alluded to you'll probably put them together. You may own 100% stocks, you may have a need to own 100% bonds, but more than likely you're going to want to mix them together. You're going to want to diversify them. I'm trying to figure out how would I explain diversification. It's a pretty technical concept when you get down to implementing it, but let's stay at like the 3,000 foot level. If we're going to mix stocks and bonds together, or any set of assets together in any meaningful way, we have to be able to predict them. We can't just say I'm going to do 20% of one and 80% of the other and hope that that's going to work. We have to be able to say we know what's going to happen if you own this type of stock or if you own this type of bond, so that you can therefore know what's going to happen when you mix them together. You put 20% of one together and 80% of the other. What that means is you have to have some pretty definable stock categories and bond categories that have a long enough track record where we can look at that history and say, we know what they do. We know what the average return is going to be. We know how that average bounces around, and we'll talk a little bit about that in a bit. And we know how they relate to other categories. So the one thing you're not going to find us ever recommend is like mid-cap financial services stock in Pasadena of people that are in the real estate industry. I mean, I'm getting kind of stupid with this, but that gets so tight and so defined, there's no way in the world you can know over the long term because it hasn't been around for the long term. No, it's more important to use the broad categories that these ought to resonate with you. You've got large cap stocks like the Fortune 500, the S&P 500. Small cap stocks, think of Apple or Microsoft when they were in the garages and just coming out and they were public. There's international stock, there are real estate investment trusts, and then there are short-term bonds and long-term bonds. That's pretty much it in terms of the categories where there's enough predictability, enough history for us to say we know what's going to happen. So what is important to diversify is to look at each of those categories and say, what's the average return if I were to invest in large cap growth stocks? What's it going to earn for me over the long term? But it's also important to know, well, what's that going to average going to be? So what's the volatility going to be around that average? I usually use the example of two investment opportunities. I tell you, look, one of them is going to earn, and has earned over the last 3 years, it earned 9%, and then it earned 10%, and then it earned 11%. Well, if we do the math, we're going to find out that the average is 10%. You think that's pretty good. I said, before you invest there, though, I got another opportunity over here, another investment, and it earned 20%, then it earned 10%, and then it earned 0%. Now, if we do the math, trust me on this, that adds up to an average of 10 as well. But you're probably thinking, wait a minute, those are really two different investments, and I want the first one because it's really tight. 10 is the average right here, but you only had 11 to 9 as the amount of variability of volatility, whereas the other one started up at 20, then went to 10, and the last year was 0. Who wants that? So without knowing that volatility factor, you really can't compare investment options. That's important with stocks as well as with bonds. So if we know the return, we know the volatility, and then we know how each category relates to the other, we can go get one of these computers and run a formula to say, well, if I put 5% of this together and 8% of that together and 20% of this together, what will it do? What rate of return will it give me? And more importantly, what is that volatility? Now you kind of know what your risk is, you know what your return is. You can make a decision. It's going to be subjective. It's the decision that's best for you, but it's going to be based on some objective information. You know your ranges, and it's so important to know that range, because if you work with someone like us or anyone else that is going to do this objectively and is really going to give you the straight scoop, they're going to tell you what the downside is, and they're going to tell you what the upside is, and they're going to tell you what that average is. What they ought to say is the one guarantee you've got is you will hit the downside within your lifetime. So if that downside's a negative 5% versus that downside's a negative 30%, you have got to be able to ride that out. What you can't do is when you experience the downside, say, oh my gosh, what am I doing with this combination? I want to get out. And that downside can last 2, 3, 4, in some rare instances, you know, stocks have looked pretty bad for 10 years or bonds have looked pretty bad for 10 years. But you start stretching out beyond that, getting into time periods of 12, 15, 20 years, there's a great deal of consistency. You're gonna earn the average return you think you're gonna earn. You're gonna experience the downside, but if you can live through it, diversification can be your best friend. It will consistently, over that long term, give you a rate of return which is predictable, and if you've done it right, is within your tolerance, and you don't have to sweat the small stuff. So hopefully, I've kind of done this at the 3,000 foot level. Again, a lot of math to it, a lot of details that we can cover. If you'd like to do that in more detail, we'd love to hear from you. So shoot us an email, give us a call. Thanks for listening.